Here's a number that should stop you cold. 44% of American households, nearly half the country, would face serious financial hardship within 6 months of losing their primary earner. Not because they don't have life insurance, many of them do, but because the policy they're paying for every single month isn't actually doing what they think it is. Today, we're pulling back the curtain on the life insurance industry, and by the end of this video, you'll know exactly what to buy, how much to get, and the costly mistakes that silently destroy claims every year. Chapter 1. The basics most people get wrong. When most people think about life insurance, they picture a check arriving after someone dies. Simple. But the actual mechanics? Most policyholders have never read past page 3 of their contract. Let's fix that. Life insurance is a legal contract between you and an insurance company. You pay premiums, monthly or annually, and in exchange, the company promises to pay a death benefit to your beneficiaries when you die. That death benefit is what most people focus on. But what they miss are the conditions that must be met for that promise to hold. First, there's the policy term. For term life insurance, coverage only exists during a specified window of time. Buy a 20-year policy at age 30. If you die at age 51, your family gets nothing. That policy has lapsed. Second, there's the premium payment requirement. Missed payments? Most companies give you a 30-day grace period. After that, the policy lapses. Reinstating it can require new medical underwriting, meaning if you've gotten sick in the meantime, you might not qualify anymore. Third, and this shocks people, there's something called the contestability period. During the first 2 years of a policy, insurance companies can investigate claims thoroughly. If they find any material misstatement on your original application, anything you said that wasn't fully accurate, they can deny the claim or reduce the payout, even if the death was completely unrelated to that misstatement. We'll come back to this because it destroys more claims than almost anything else. Chapter 2. Term versus whole life. The great debate. If you've ever talked to a life insurance agent, you've likely heard about 2 main types of policies, term life and whole life. And the conversation probably went one of 2 ways. Either the agent was pushing you toward whole life or toward term. Here's what they might not have made fully clear. Term life insurance is pure insurance. You pay a fixed premium for a set number of years, usually 10, 20, or 30 years. If you die during that term, your beneficiaries receive the death benefit. If you don't die during the term, the policy expires and you get nothing back. It's the simplest, cheapest form of life insurance. A healthy 35-year-old can get $1 million 20-year term policy for roughly $30 to $40 a month. Whole life insurance, by contrast, is a combination product. Part of your premium goes toward the death benefit. The other part goes into what's called a cash value account, an investment vehicle managed by the insurance company. The policy never expires as long as you keep paying, and you can borrow against or withdraw from the cash value while you're alive. Sounds great, right? Here's the catch. Whole life insurance costs 5 to 15 times more than an equivalent term policy. That healthy 35-year-old? The same $1 million whole life policy might cost $400 to $600 per month. The famous financial principle known as buy term and invest the difference argues that most people are better off buying cheap term insurance and putting the premium difference into index funds, which historically outperform the guaranteed but modest returns inside whole life policies. But whole life does have legitimate uses: estate planning, permanent coverage needs, or for people who can't trust themselves to invest independently. The bottom line, don't let anyone tell you one product is universally better. It depends on your age, income, family situation, and financial goals. Chapter 3. The underwriting game. How insurance companies actually price you. You don't just apply for life insurance and get approved. You get underwritten. And understanding the underwriting process could save you thousands of dollars over the life of your policy. Underwriting is how insurance companies assess your risk. In blunt terms, how likely they think you are to die during the policy term. They do this through a combination of your application, a medical exam, your prescription history, your driving record, and sometimes even your credit score. Based on this, you get placed into a risk category. The exact names vary by company, but they typically look something like this: Preferred Plus or Super Preferred, the best health, best rates. Preferred, very healthy, excellent rates. Standard Plus, healthy, moderate rates. Standard, average health, average rates. Then substandard categories, which cost significantly more. Here's something most people don't realize. You can be declined or placed in a high-risk category for conditions that aren't even active anymore. Had a DUI 10 years ago, that can hurt your rating. Were diagnosed with depression and treated successfully 5 years ago, that goes on your record. Had your appendix removed, insurers want to know. The prescription database is particularly revealing. Companies like MIB, the Medical Information Bureau, collect data from past insurance applications. If you applied for insurance in 2018 and listed a medication, that information may still follow you. This is why it pays to work with an independent insurance broker rather than a captive agent who only sells one company's products. An independent broker can shop your profile across dozens of companies and find the one that's most lenient about your specific health history. Someone with well-controlled diabetes, for example, might get wildly different rates from different insurers. Chapter 4. How much coverage do you actually need? This is where most people either wildly underestimate their needs or buy far more than necessary. Let's break this down practically. The old rule of thumb was 10 times your annual income. If you make $80,000 a year, get an $800,000 policy. That's not wrong, but it's not precise either. A better framework is what financial planners call the DIME formula: debt, income, mortgage, education. Start with debt. Add up all your debts: car loans, student loans, credit card balances, everything your family would need to pay off if you weren't there. Then income. Multiply your annual income by the number of years your family would need financial support. For most families with young children, that's 10 to 20 years. Then mortgage. What's the remaining balance on your home loan? That needs to be covered so your family doesn't lose the house. Finally, education. What will it cost to put your children through college? Even a rough estimate matters here. Add all four numbers together, then subtract any assets your family could liquidate: savings, existing life insurance from work, retirement accounts that would become accessible. Let me give you a real example. A 38-year-old with a $70,000 salary, a $250,000 mortgage, $40,000 in other debt, 2 kids, and a plan to retire in 22 years. Running the DIME formula: $40,000 plus $1.54 million for income replacement, plus $250,000 for the mortgage, plus roughly $300,000 for 2 college educations, minus $50,000 in savings. That's about $2.08 million in coverage, far more than the simple 10 times formula would suggest. Your needs are uniquely yours. Don't shortchange your family by guessing. Chapter 5. The claims mistakes that silently kill policies. Everything we've covered so far means nothing if your policy can't pay out when it needs to. Let's talk about the most common ways claims get denied and how to prevent them before you ever need to file. Number 1. Material misrepresentation on the application. This is the big one. When you apply for life insurance, you are making a legal declaration of your health history. If you lie about smoking, and yes, they test for nicotine, or fail to disclose a medical condition, or say you don't engage in high-risk hobbies when you do, the company can deny the claim. During the first 2 years of the policy, this is especially dangerous. They will investigate. Number 2. Lapsed policies. You'd be shocked how many families discover that their loved one's policy had lapsed, sometimes for as little as 1 missed payment, right before they needed it most. Set your premium payments on autopay. Check your policy status once a year. Number 3. Beneficiary designation errors. If your named beneficiary has died and you never updated the policy, the payout may go to your estate and get tied up in probate, which costs time and money. Update your beneficiary designations after every major life event: marriage, divorce, birth of a child, or the death of a prior beneficiary. Number 4. Not telling your family the policy exists. This sounds almost laughably basic, but the American Council of Life Insurers estimates that billions of dollars in life insurance benefits go unclaimed every year because families don't even know to file. Keep a document somewhere safe that lists all your insurance policies, account numbers, and the insurer's contact information. Tell at least one trusted person where to find it. Life insurance isn't about death. It's about making sure that even if you're not here, the people who depend on you still have a future. If this video helped you understand something you didn't before, that's exactly what this channel is about. Breaking down the complicated world of insurance into information you can actually use. Hit subscribe so you don't miss the next deep dive. We cover life, health, and auto insurance with the same commitment to honesty and real-world value. See you in the next video.